following program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.
Welcome to the Bullington Capital Report, hosted by Bill Bullington. For the next hour, you'll receive information on current market conditions and trends that could affect your financial future. If you have a question for Bill, you can participate in today's program by calling 216-901-0945. That's 216-901-0WHK. You can also reach Bill by going to his website, bullingtoncapital.com. So without any additional delay, here's the host of today's program, Bill Bullington.
And back again. Like the guy said, feel free to call us, 216-901-0945. If you have any questions regarding investments, retirement planning, retirement income planning, that's kind of a big deal these days with 10,000 people turning 62 every day in the United States. So kind of where we focus our efforts. And we got a seminar coming up. This is going to be Thursday, May 11th. It's hard to believe it's near the end of March already. Wow. Anyway, it's going to start at 7 o'clock, Corporate College East. I will meet a little bit early for those people that want to kind of go over the, look out for the Bull website. So I'll be there around 6:30, and we'll talk for about 15 or 20 minutes. And then at 7 o'clock, we're going to talk about the key to successful investing, choosing an investment strategy that suits you. We got to get one that suits you. That's the kind of a big deal. Most investors, well, I shouldn't say most, a lot of investors, according to Dalbar, it's a market research firm who studies investor behavior. Been around for a long time too, by the way. And they do really good work. So anyway, they publish this study every year. They take a poll and then they do research through the, I forgot what, there's a company out there, and I'll remember it. ICA is the Investment Company Association. I can't remember. Anyway, they track the flows of in and out of mutual funds and the types of mutual funds every year, and they work together. Dalbar works together with them to kind of study the behavior of the average investor. And the average investor has a tendency to pull out of markets when they've dropped, and has a tendency to buy back in later after they've gone up quite a bit. And that's a real problem in the long run. Having said that, by the way, if you are a momentum investor, there are a lot of momentum funds out there. The Janus 20, you may remember. The guy that was running it, John Marzico, started a firm a few years ago, got up to $100 billion in assets, and that style went out of favor, and his asset base is at $3.5 billion now. Still a lot of money, but it's a lot different than $100 billion. And if you're a momentum investor, oftentimes you're going to see that those strategies have a tendency to have very long spells of underperformance, and people start to pull out of them. And typically, when I see that that there's an extreme, I'm thinking in the back of my mind, because I've been doing this for so long, that it's better days are probably ahead for that. And for those types of strategies. So if you've got those in your portfolio, and I've got a bunch of them, past 2.5, 3 years, it's been really tough. They've made very little money. In fact, nothing's made a lot of money. You hear a lot about the S&P and whatnot, but if you take out the largest stocks in the S&P, it just hasn't done very well. The S&P is only about 9% higher than it was a couple of years ago. And so that's kind of incredible when you think about it, when you've heard all the headlines, they keep talking about new highs. But, that's one of the things you got to be aware of. And it's not a bad thing. I think it probably the way that it's presented gets misinterpreted quite often. And I don't like to think that that's intentional, but, is what it is. The reality is markets have not gone up a lot over the past 3 years. There are certain segments of the market that are overvalued now, and the ones that have performed more poorly, I would be more interested in. Why? Because they're probably worth more. The company's valuations are probably lower. They're selling for lower prices relative to what they would normally sell for than some of the bigger names that have done well. And that is really confusing to an awful lot of investors, which is why we're doing this seminar, trying to pick investment strategies that suit you. And this is something that I used to really try to discourage, is comparing your performance against the S&P 500 or the Dow Jones Industrial Average or the NASDAQ if you're invested in technology. Because unless you're doing very similar things, if you're doing very similar things, then you can make that comparison. But if you're doing something different, then you really shouldn't be comparing yourself to that, because you're going to set yourself up and hurt yourself. When those have done well and when they've done better than your strategies, you're going to think that you're doing something wrong. And it might not be anything that you're doing at all. It may just be how that particular strategy works. And not a lot of information out there about this kind of thing. It's growing. That's very positive. And I read around some of the various websites, the information regarding styles, strategies, how their seasonality of different types of styles. There's more writing on it now than there used to be. So that's a good thing. And because it's very important that you know how your strategy has a tendency to perform and what it's doing. What are they doing? They're typically not that complicated. They really aren't. Even with the plethora of new funds that come out, when you read the first part of the prospectus and they explain what they're doing, realistically, it's only a couple paragraphs if you know where to find those couple paragraphs. That's a little difficult because those prospectuses are generally, there's a lot of material in there. But you really wanted to go to the description of the investment philosophy, if you can find it in the prospectus. It's generally only a couple of paragraphs, and they tell you what they're going to be trying to do. And that's kind of key. And I'll give you an example. The most popular model I have right now is the high dividend model, the Bullington Capital high dividend model. You want to hear more about it? There's a video on it on my website. It's less than 2 minutes. I think it's about 1 minute and 30 seconds, something like that. Anyway, it gives you the highlights. And what am I doing there? I'm taking the 500 largest companies in the country, breaking them up into the 11 major sectors. Used to only be 10, now they're 11. They've split that up one more. So take the 11 major sectors that make it up, and then I buy the 4 stocks with the highest dividend yields in each one of those sectors. And that's it. That's the strategy. Now, to go into a little bit more depth with that, I will tell you, when I first started it, I was running it slightly differently. The only difference was I would allow one sector to have more than a 10% exposure. I don't do that anymore because I just feel like having the broader diversification. I like it, but I'm more comfortable with it. And as soon as I switched that, having concentrated the way that I started originally actually outperformed. But that's okay because they both did well. And since then, it's actually helped quite a bit. So but it just figures, that's my luck. Anyway, you look at how that works. Okay, the stocks they're all paying dividends. The dividends are always coming in. They're always buying more shares. When the share prices drop, the dividends are reinvesting. They're buying more shares at lower prices with a higher yield. That's a big deal. That's a really big deal. Is it always going to win? Heck no. The first year I started it, the momentum models I have smoked it. The momentum models I had made, actually the more conservative momentum model only beat it by a little bit, but the more aggressive momentum model beat it by 50%. 50%. Since then, I will tell you that the dividend model has caught up and actually is slightly a couple percentage points ahead now of the momentum model. But why? Because the market's actually gone choppy sideways. Hasn't made a lot of progress over the past 3 years. In fact, when we come back from the commercial break, the first commercial break that we take, I'll actually pull that up on the S&P 500 and explain what I mean by that. Because you go back and you look over, you go to 2014, right around this time, and actually I can do that for you as we speak. It's up about 16%. Over 3 years. That is let's see, that's a little over 2 years. So over 2 years, about 16%. And by the way, that's actually better than an awful lot of other funds have done. Particularly momentum styles of investing. So over the, again, you're going back to a time period of over 2 years. No, I think that is 3 years. Yep. 3 years, you're only up 16%. That is not a lot. It's a little over 5% a year, but you've had a correction in there, a couple corrections that were pretty big in 10%. So doesn't seem like, you're not doing like you would have done had you just invested in 2010 or 2011. You had a huge move up in share prices. 2011 through 2014, actually it peaked right in around 2014. And then it went sideways for almost 2 years. And recently, it's made a little progress. So looking at performance over too short of a time period, and too short of a time period is actually anything less than 4 or 5 years. You're looking at less than 4 or 5 years. That is way too short. And 5 years is not an easy one. In fact, the S&P 500 first, peaked out at a level in 2000 that it didn't see again until 2007, right before it went down 50% again. And then it didn't see that level again for another 4 years. Okay, so you're talking about greater than a 10-year time period where S&P 500 actually had a negative return. So, and I know most people don't want to see that. See, here's the rub, though. If you don't want to see that, there's a pretty good chance that when the S&P 500 is going up really fast, that it's going to beat you over a 1 or 2 year time period. So if you want to have better performance, you really have to look out a lot longer than that, and you have to put up with the fact that you could be lagging behind the index for an extremely long time period. And that, I know that is the toughest thing about investing. You can be doing all the right things and you're still underperforming the market in the short run. If you're doing the right things in the long run, you'll probably be rewarded for that at some point in time. The reason I say probably is because we're not allowed to guarantee anything in my industry. We're not. It's against the law. Literally, it's against the law. They could take my license for that. So when you say guarantees, and by the way, some companies do guarantee that. Insurance companies who sell annuities are allowed to make guarantees. The guarantees are only as strong as the insurance company. And so if the insurance company has guarantees that they can't make good on, that insurance company goes away. I got to experience that firsthand, but I worked at the third largest insurance company in the country back when I first started in the industry. They no longer exist. They made the guarantees and they couldn't make good on the guarantees. They had to put themselves up for sale. And it's very similar to a bankruptcy proceeding, actually. So it can happen. By the way, nobody got wiped out on that. They got less money than they thought they were going to get. Their guarantees were reduced. That's what happened. The guarantees were reduced. If you're unlucky and a family member had invested in some of those products and had passed away, they could have inherited less than they started with, but it didn't wipe anybody out. So just keep that in mind. Guarantees are only as good as the company behind them. Your highest level of guarantee, incidentally, tends to come from the United States government, because the United States government owns its own printing presses and can print the money and hand it to you. Realistically, they can do that. That's one of the reasons you don't ever have to worry about the stock market going down and not coming back. It's probably not going to happen. It hasn't happened in the past over 200 years. It actually hasn't even happened in Europe, where their stock markets are older than our country is. Now, you might not get the returns you'd hoped, but the chances of a stock market decline where the stocks go down to zero or lose 70 or 80% of their value and never come back, it's very, very, very remote. I would say the chances are about the same as the Browns going undefeated next season. I mean, it could happen, but I wouldn't count on it. Okay, so and that's a tough thing to have confidence in your economy. I have complete confidence in the United States economy. Why? Because I've been watching this since I've been in college. It's been very interesting to me. Don't know why, but it's one of the reasons I majored in economics, because I just thought it was interesting. And when you figure out, or when you learn about how it actually works and how it's been set up, you're going to relax. You will relax. You may not get the returns that you want. And I think we might have a phone caller, by the way. If you want to call and ask a question, 216-901-0945, 216-901-0945. The real risk, incidentally, to your investments is that inflation erodes their purchasing power. We'll talk about that in a little bit. Right now, I got to go to the phone. Got a call from Sherman. How you doing?
Hey, doing well. How you doing there?
Good.
Good. I was calling to see. So I was calling to see. You're talking about momentum funds, and then you're talking about the dividend fund.
Mm-hmm.
Are there any specific keys that would say, hey, it's time for the momentum to take off? I know you talk about when the GDP gets at a certain rate, but are there any other things that someone looks for?
Yeah, you can. It's very active, though. You would be. You'd have to watch the market on a continual basis for that. In making the changes, by the way, it doesn't necessarily guarantee. But here's what you'd look for. There's a rule through the SEC. There's a certain size a company has to be before a mutual fund is allowed to invest in it without jumping through a tremendous number of hoops, filing with the SEC and letting the entire world know that you plan on investing in these companies. Mutual fund managers and institutional money managers are very hesitant to do that. They're very hesitant to signal to the rest of the world what they're going to be doing ahead of time, because the other guys would jump in, drive the share prices up before they could get their fill of it. Does that make sense?
Yeah, it makes a lot of sense to me. I was just wondering how a small investor would be able to spot those trends.
What you could do, there's a program out there called Telechart, and I just subscribe to it, and I look at the number of stocks that are investable, by a mutual fund. In other words, they're not so small that a big mutual fund can't buy them. And so I start that at $250 million. That's a good starting point. Company has to be above $250 million. There are 3,200 stocks roughly that meet that criteria right now. So that's where the mutual funds are going to be looking. Okay. So I divide that 3,200 into stocks where the short-term trend is up, and I compare that to the number of stocks where the short-term trend is down. When you see that more than when the ratio is 2-to-1 in favor of the stocks in the short-term uptrend, that's when momentum tends to work really well. Hey, do you want to hang on? I got to take a commercial break.
Sure, that'll be fine.
All right, hang on one second. You're listening to Bill Bullington right here on 1420 The Answer. I'll be back after these messages. And we're back. Hey, Sherman, you still there?
Yep, I'm still here. Maybe I'll call that vacation fixation commercial back.
Yeah, yeah, it is. Yeah, it's pretty cool. Yeah, that's actually a business of one of my clients, and it actually, it's a pretty good deal. But anyway, we were talking about what you could do, and I haven't figured out a good way to do this. So I typically once a year I'm rebalancing, which means if something has underperformed, it's actually going to get more money. When it's outperformed, I'm going to take some of that money and move it over to the other side, because they typically don't outperform for years at a time. Actually, I should take that back. Sometimes they do. So what you're always doing is you're actually always rotating into the strategy that you have that you feel like has the better chance of outperforming in the future. And basically it's the buy low, sell high thing. When it's underperforming, you're adding to it. When it's outperforming, you're taking money and moving it to the other side. That's the easiest way to do it. You'd only be doing it about once a year. And that'll try your patience, by the way, because the cycles are actually longer than a year. So you would be adding to something 2-3 years in a row going, oh, geez. And then once that thing pops, then, you catch back up and then pass it again. But that is really challenging for an awful lot of people. The other alternative that you would have is to track this yourself and then change your allocations in your portfolio based on the changes in the market. Right now, out of the 3,200 stocks or so, just a little bit over 3,000, 1,675 of them are in a short-term downtrend. Okay, so that means the others are in a short-term uptrend. And
it's a 50-50 chance.
yeah, it's basically telling you the market's really just churning and kind of going sideways. So you really wouldn't expect either one of them to outperform by a lot. Now, I will tell you that number was really positive. It turned positive about 2 weeks before the election. So what that tells me is that people were anticipating change. It didn't matter who won. They were anticipating the change, and they thought that the change would be good. I can understand that because GDP growth was below the long-term average for 8 years in a row, and it would make sense that any sort of a change, it's got to be an improvement over that. So the market actually said that moved 2 weeks in advance of the election. And what was really funny is the night of the election, man, the Dow futures were down like 800 points. So, when the market opened, it actually ended up closing up for the day. So it erased that one. That's one of the reasons I don't like to day trade. Man, that is crazy. That's insane. So, but yes, you could follow this, and I'm trying to get we've been working on a model like this for about a year. We're trying to get it so that logistically we can offer this to clients because it's pretty active. I mean, you'd be having shifts probably 3-4 times a year. And the idea is to keep your overall allocation to stocks. So let's say you had a 60-40 blend, stocks to bonds, okay, bonds and cash. Mm-hmm. That 60%, the allocation would vary between the high dividend model and the momentum model, depending on which part of the market was performing the best at that particular moment in time. And I don't think you'd have to do it you'd have to change those allocations more than once a month. And I can tell you over the last 4 to 5 years, it would have made a difference. You'd have probably picked up around 3 or 4% a year doing that. Don't know if it will always work that way, but that's the way it looks like it's been working now. We just have to figure out a way logistically to be able to do that over a large group of people. That's the hard part for us. As an individual, you could just watch and do it yourself if you wanted to do that. It would be pretty difficult. You'd be spending a lot of time with it. And quite frankly, it'll stop working at some point in time. When I first started in the business, the types of things that people did back then versus today, the things that I did back then, they've all changed. They don't work anymore. In fact, the market is constantly evolving a little bit, and that's what happens. You get a little bit of a change, and a little bit of a change compounded over 4 or 5 years ends up being a fairly significant change. And then over 10 years, it's a kind of a big change. So keeping up with that. Pardon me?
No, well, I was going to say, what you're saying that some of the changes, like what is it? Just because of the technology and information comes so much quicker that people are in and out, much more big houses are in.
Yeah, and by the way, they're actually making less money because of it too. The returns have actually gone down. So because you've got more activity, and a lot of the activities, there's no benefit to it. In fact, the volatility has increased. The number of 2% up or down days in the past 16 years, it's higher. I think I told you it was past 100. I was wrong there. It's higher than it has been collectively over the past 60 years. So the past 16 years, since the year 2000, you've had more days where the S&P has been up or down 2% in a day than you did going all the way back to World War II. More days over that time period than you had in the entire, 60-something years before then. So, and that's all computer driven.
Just because everybody can see what's going on so much quicker. So what? They jump in, take small gains, get back out, get back in.
No, they take in. No. They get a small loss and they get back out, and they do that 2 times for every time they make a gain, and it's made their overall profits smaller. They've got to get a really big winner in there just to keep their head above water. And for a lot of people,
go on. I'm sorry.
For a lot of people, that hasn't been happening, particularly in the last 2 to 3 years. But it's not like it's impossible. But if you're a big fund, you can't do that. There's no $1 billion fund out there that can do that. And there are over 4,000 funds now that have over $1 billion in them. There are only 3,200 stocks for them to choose from. So you got over 4,000 funds that have over $1 billion. And when you start adding the other funds together, there's at least 6 funds for each stock that's available. and that.
Well, that's got to manipulate the price. I mean, when you think about if they're limited to that number, the number of stocks they can buy,
right,
and all those houses that are buying them.
Yes. So if you're going to outperform, you're actually going to have to go against the grain. You're going to have to be a true contrarian. You'll either like the momentum thing. That's a contrarian move. Very few of those funds are going to do that. They don't want to do that. It's very difficult for them. In fact, for most of them, it's impossible because they're just too big. The value side, you're going to be buying stocks that are dropping. That's what the dividend model does. And in fact, over the first few months that you invest in the dividend model, there's a good chance that it's going to go down because you're buying stocks that are paying dividends. They're big companies, but the dividend yield only goes up when the share price goes down. It's the recovery and the fact that you got dividends while you were waiting, and those dividends purchase shares at lower prices with bigger yields. That's what actually makes that thing work. So there's a really high likelihood that the first 6 to 12 months that you hang on to a value-oriented portfolio, that it's going to go down. And I probably should have emphasized that more. Now thinking back, about it, because I just started another value model that only concentrates on cash flow, not the dividend. And I put it in my own portfolio first. And of course, I'm down about 8.5% since I started about 6 weeks ago.
Yeah, it does. I think everybody that buys stock, it always goes down after you buy it. It always happens. And then it goes back.
Well, yeah. And that's the key. And so you got 2 choices. You can actually use momentum, or you can use the value-oriented thing like the dividend yield or the cash yield. And those are opposite ends of the spectrum, by the way. They tend to actually be fairly lowly. The correlation's pretty low. And when they're both going down, it's because the market's crashing. So that's why you have bonds, and so that you're not too volatile. But that idea you have, we've been working on that one actually for over a year of trying to shift between the strategies as they shift, as momentum's becoming more attractive. If we can figure that out, you'll be the first one I call.
Thanks, Bill. Whenever I talk to you, it just makes it seem so impossible for a small investor, because I used to, read and invest on my own, and then I found out I just can't beat it. The people that are doing it professionally, looking at it day after day like you do, can't beat it. I mean, sure there are individuals that can, but if you're working full time, just leave it to the pros. That's kind of been my approach.
Well, it's gotten harder.
With you several times.
Yeah. And it's gotten harder over there. Even in professionals, like I said, if you're going to beat the market in the long run, you got to be willing to underperform it for 4 or 5 years, sometimes even longer. And that is not an easy task. It weighs on your conscience, wakes you up at night. But
You want gains, especially if you hopped in there and you go, hey, here's my retirement income. You throw that in there and go, wow, 4 years it declined.
Yeah.
Nobody wants to do that.
Well, yeah, and that's one of the reasons I do the kinds of things I do. The recovery period on the things I do is actually shorter. Yeah, and that's a big deal. Having a quicker recovery period is a big deal. At least it has been in the past. We're not allowed to promise anything. So every time I say something like that, I have to remember and remind myself, make sure you're not promising.
You haven't made any promises to me, but the gains have been certainly worthwhile.
Oh, thanks. I appreciate it. And I really do feel good about the economy. There are so many things that are behind the scenes. It's the infrastructure projects. They've been going great guns. you don't see that. It's not front and center like housing or automobiles. Who knows? The technology that's increased in the pipelines, it's unbelievable. The pipelines have robots in the pipelines. They're literally robots. And they're measuring, they're looking for cracks, they're separating, and they actually clean the inside of the pipeline because they're putting so many different materials through pipelines now. And you should look at that on it is mind-boggling. And the money that gets spent on that is huge. The energy complex is about 30% of GDP. 30%. That's actually higher than healthcare.
That's huge.
Yeah.
That's huge.
And that's where most of the growth has come from. But people are not aware of that because it's not front and center the way that Ford, GM, Chrysler, and all that. Those guys, everybody recognizes that housing. That's something that people deal with every day. They don't realize that the natural gas coming to their house has probably traveled several thousand miles through a pipeline that's been pushed along by a robot.
But hey, so one last question, and then I quit taking up all your time. I'm sure you got other calls.
Oh, that's okay.
Today, but when the failure of the health care to go forward right now with the overriding Obamacare, but President Trump talking about now moving towards tax reform. You think there's going to be a lot of change happening in the market? I mean, I'm sure it depends on what it is, but he's basically, the things that I've heard him talk about are reducing taxes for corporate America to get people back here, get the economy boom, but also for the individual family, and the individuals too. So put some more expendable cash in their pocket.
Sure.
Think there'd be much impact there quickly, or
you get a boost, by the way, because individuals will spend that money 10 times quicker than the government will. So
but you'll spend it if it's yours.
Yeah. So it'll be good. It'll give a boost to GDP. Just the fact that it's actually being spent quicker than the government can. Government has to collect the money first of all, and that takes a long time. Once they've collected, then they have to count it. Then they have to allocate it, and so we've all seen it how fast the government's been. By the way, the government expenditures, the federal government, somewhere around 20% of GDP. When you add state and local governments, total government spending is about 30% of GDP. So if that government spending is slowed down, the economy is going to slow down. It's not an if. It's going to slow down. So, and that's what people were so frustrated about, and why the stock market started to rally, because they were sensing change. They weren't sensing a Trump win or a Clinton victory. They were sensing change. And they figured that change has got to be better because you're below average for so long, longest in the history of the country that GDP growth was below its long-term average, 8 years. And they were anticipating that change was going to be good. And I have to agree, the change is good. A lot of the things that they've been talking about. We had an accountant here a few weeks ago. His name is Jeff Brooks from Apple Growth right here in Akron and Cleveland area. They were going through some of the changes, and that's not a trick, man. That's an easy one. That's like I got a gasoline engine in my lawnmower, and it's not starting. So you prime the pump, you pour a little gas in the carburetor, and then it starts. It's the exact same thing. That stimulus works, but you don't want to spill the gas all over your hands and your clothes, and then light a match. Close to it, because you might catch on fire. So you have to be very careful with the economy that you don't overstimulate and overspend, because if they give you taxes, that means the government's got to make up for the lack of tax revenue by going deeper into debt. So you got to be careful. It's something that is a constantly changing environment, and you have to make adjustments. So if they do it carefully, if they're successful in their plans, could lead to a lot of stuff. They just got that Keystone approved. Now it's got to go through state and local governments, by the way. And that's actually the biggest problem with the pipelines is you have to get permission not only from the federal government, but you got to go to each state, each municipality, each county. You know how hard that is? You're going over.
Isn't it like Abraxas? There's an Abraxas, some type of line going through Ohio out in the rural areas that they want to pump natural gas. They got to go actually to the individual farmers in that.
Yeah.
crossing it over their land.
Well, actually, yeah, and it can be. Hey, I got to take another commercial break. Did you want to hang on?
All right. Actually, I got to get going
Okay.
here, Bill. Enjoy talking to you.
All right, have a
Doing
good
great
weekend.
job out there.
All right, thanks. Whoops, you're listening to Bill Bullington right here on 1420. Stay tuned. I'll be right back. And we're back. Again, like it or not. Just kidding. Oh, hey, I was looking at a couple different things. By the way, if you'd like to call in 216-901-0945, we've got about 10, maybe 12 minutes left. So feel free to ask a question. Feel free to email me, bill@bullingtoncapital.com, or go to my website. There's a contact us form there if you have questions. And I'm always very optimistic, even during the crash. Why was I optimistic during the crash? Because of the way the economy is set up. It's set up to self-heal. As long as Congress gets around to passing the legislation, which eventually they do, and that has a lot to do with the speed of the recovery. How quickly are they responding? Headlines today are all about the divided GOP drops the health bill. It's the headline on the weekend edition of the Wall Street Journal. I'm not sure that is nearly as important as the banking system, what they're doing. In fact, I'm quite sure that it's not. Healthcare is 20% of GDP in the United States. That's a big chunk. We spend roughly 20% of gross national product on, I'm sorry, gross domestic product rather, on healthcare. So what does the dropping of the GOP bill mean? I don't think it really means a lot, quite frankly. Yeah, I don't think it's going to be that significant. We've been operating under the existing system, and all they're saying is it's going to stay in place for a while longer. And all the stuff that you're reading about, all the bad news that they're talking about with that, yeah, that's kind of already factored in. So there are some changes that need to be made, in my opinion, personal opinion. Yeah, we can talk about that on another show. But the basic system, it's in place. We've been using it. World hasn't ended. Probably ain't ending now because it's just more of the same. Is it something that is a problem? Yeah, but we can deal with it. Where you have big problems, the really big problems are when loans go bad. When loans go bad, when the banks start losing money on loans, then you have big problems. That's where you get the 2008, 2009 type of correction. Corrections come along typically every 12 to 18 months, despite what's going on in the economy. A lot of it's just mass psychosis. But that's pretty normal. Are you going to be able to predict that? Probably not. Are you going to let something scare you out of the market? Well, that's going to have a big impact on how well you do for the rest of your life, quite frankly. If you're prone to overreacting to news, you're going to have a tough time making any money in financial markets. If you have a strategy in place that suits your personality, that's really what we're talking about at the next seminar. And since I mentioned that, I just hid the bar on my website that gives me the date. It's May 11th, 2017, so that's a Thursday. It's going to be at the Corporate College. Go to Bullington Capital to sign up online. And choosing investment strategies that suit you are key. I can tell you that the information that you get on the internet is not enough to be able to make investment decisions, good, sound investment decisions. You have to have a little bit more than that. And basically, it requires reading the prospectuses, which you can download online. They're just not readily available. You've got to be able to find that. Then you have to read it. Then you have to find that section within that prospectus, figure out what it's done. Then you start looking at track records and expenses. By the way, if you just look at the track record, you can forget looking at the expenses because that's net of fees. I'm saving you an awful lot of time there. And the idea is to try to find out whether or not you think what the portfolio manager says in the prospectus makes sense to you. It's like our strategy for the dividend model, it makes sense to me. Our strategies in the momentum models, they make sense to me. Those are two extremes. One of them is a deep value approach. The other is a price movement, what a lot of people refer to as growth. Most of the stocks in the momentum model are going to be growing fast. They'll either be growing fast or it's a stock that's very undervalued and the growth is anticipated to be returning. That's typically what drives the share price movement up and gets it into the model. So they're the opposites of one another. One of the reasons I like using them is because one is generally not performing at the same time as the other one is. And over long periods, it happens to make that a little smoother, although it does make it uncomfortable when one of them is underperforming. And I would have to say that the momentum over the past 15 years has underperformed for longer time periods than the value-oriented ones. So I got to take a real quick call here. You can call me at 216-901-0945 if you'd like to. And I got Jerry. How you doing?
Good morning, Bill. Got a question for you. This AAOI was on the charts again this week. Is it the company itself as much as it's the industry it's in, or it's a combination of both? Because I'm starting to look at some of its colleagues in the industry, and they're looking kind of interesting also.
Oh yeah, the industry itself has been doing exceptionally well. So that always has a big impact on a share price of one of the companies in the industry group. And that's been well known. There are still a bunch of funds out there who still do sector rotation. They don't like to say that, by the way, because it hasn't worked that well for a pretty long time. In fact, if you're not an individual investor who has a whole lot more control over your portfolio and you've tried to invest that way, I can tell you all those strategies are lagging. Okay? They're lagging, and they will lag until one day they don't. And if I could predict that, Jerry, I'd invite you up in one of my personal jets.
Okay. How about Corning? Is it in this
No.
same type of company, or is it different?
Different altogether.
Corning is fiber optic, isn't it?
No, you could go to their website. You should see how much stuff Corning does.
Okay.
It is mind-boggling.
Well, it was getting the play for being on the fiber optic cable. Wasn't that the big part that was touted?
Well, let me just repeat myself because you obviously didn't hear me.
No, I did, but I thought that was the major part of what was.
Go to the website and you see what all the things that they're involved in, and you'll go, oh.
Yeah.
Better than me. Yeah, it's huge. It's huge, and they have all kinds of applications. Fiber optics just one of them.
Mm-hmm.
And I'm not even sure fiber optics is more than 10 or 15% of their revenue.
Right. Okay.
Yeah.
Very good.
So, all right. Well, hey, thanks.
Thank you, Bill.
Have a good week. Yep. And I'm going to go right to George. George, you're on the Bullington Capital Report.
Hi, how are you today?
Good.
Hey, I got a question about what the government did after the crash in 2008.
Sure.
She could tell me. It was my understanding that when the government gave out all that money, the auto industry had to pay their money back, but the banks did not. Is that right?
Each deal was a little bit different. In some cases, what you said is accurate, and others not so much. So you'd have to go and look on a deal-by-deal basis. That's the way that they did that.
So do you think that some of the banks had to pay their money back and some did not?
Some of the banks who could not afford to pay their money back were taken over, and their assets were given to other banks. So that's what happens when a bank goes belly up. The bank can actually go away. Lehman Brothers was an investment bank. They did a lot of traditional banking in addition to investment banking. They were literally taken over. Their assets were distributed amongst other firms who were bidding on them, so they didn't get a break. Okay. AIG, on the other hand, who has some banking functions but is not really known for banking, really known for insurance. They my recollection of this is actually very gray at this point. They got a better deal, I thought, than Lehman Brothers, but I could be wrong. I'll have to double check that. And that's the problem. See, you can't make a generalization like that. Every deal is different, and you have to look at them all individually.
So are you saying that if I did some research that some of the banks that were helped and survived, some of them had to pay the money back and some did not?
Yes, that's exactly what I'm saying. And the ones that did not have to pay the money back are the ones that were in so bad of shape that they ended up selling their assets to other banks, like a fire sale.
Okay.
So.
All right. Thanks very much. I appreciate it. I'll look it up.
Okay. Thanks. Thanks for calling.
Thank you.
Yeah. That's and that is tough. We all like to try to oversimplify some things, and that's a human nature. It's called a heuristic. That's what we do. We try to identify situations, label them so that we don't have to think a lot when we're going to recall that later. It's like driving your car. A lot of driving your car is an innate, intuitive response now because you've been doing it for so long. The problem becomes if something is not normal, but you're reacting to it as if it were normal, then you could end up hurting yourself, especially financially. And that's we all suffer from that, by the way. That is not something that one person does. You have to really try to be on guard against that. It's not easy. Investing is not easy. And if I weren't doing this myself, I'd want to get with somebody that was. And somebody that would invest my money the way I would if I didn't want to take the time anymore to do it. And that involves an awful lot of understanding. And quite frankly, there are certain styles you are going to like better than others. A lot of people, love the dividend model I'm running, especially because over the past few years, it's actually done quite well. People that were in earlier love the momentum model. It hasn't done well for the past 3 years. Okay, but the prior 3 years had done phenomenally well. Okay, so and despite the fact that I try to remind them that, these are all cyclical. They all have their days in the sun, and you got to be ready. It's still a hard thing, and people forget. I get it. You have a life. You have a normal life. It's not like mine. Anyway, thanks for listening, everybody. I'm here every Saturday morning from 11 to noon. My name is Bill Bullington. I'm the owner of Bullington Capital Management. You go to my website to learn more about us. Have a good week, good investing, and good luck.
You just caught another episode of the Bullington Capital Report, broadcasting every Saturday morning at 11 a.m. on AM 1420 The Answer. If you have a question and would like to speak to Bill personally, you can call him at 330-664-0700. That's 330-664-0700. Or contact him through his website, bullingtoncapital.com. That's bullingtoncapital.com.
Past performance may not be indicative of future results. Therefore, no current or prospective client should assume that the future performance of any specific investment strategy, including the investments and/or investment strategies recommended and/or purchased by advisor, or product made reference to directly or indirectly will be profitable. Different types of investment involve varying degrees of risk, and there can be no assurance that any specific investment will either be suitable or profitable for a client's investment portfolio. No client or prospective client should assume that any information presented serves as the receipt of or substitute for personalized investment advice from the advisor or any other investment professional.
The preceding program has been paid for by Bullington Capital Management, LLC.
The preceding program's views, claims, or representations may not reflect those of AM 1420 The Answer or Salem Media Group.